Everyone is staring at gold's crash, the red candles, the headlines, the percentage drops. And that's exactly why most people are missing what actually matters, because price is the loudest signal, but it's rarely the most important one. What just happened to gold wasn't random, and it wasn't a failure. It was a reaction. Gold had gone vertical. Momentum was extreme. Positioning was crowded. When that happens, markets don't ask politely for balance, they force it. This move didn't begin with fear. It began with positioning. Too many traders were leaning the same way. Too much leverage was sitting on one side of the boat. And when something shifts, even slightly, the math takes over, stops get hit. Margins get called. Positions get liquidated, not because the thesis broke, but because risk did. That's the distinction almost no one makes. Gold didn't suddenly lose its role. Central banks didn't stop accumulating. Governments didn't solve their debt problems overnight. But screens told a story of collapse, and screens shape behavior. When price falls fast, people assume something is wrong. They assume insiders know something. They assume the move higher was fake, so they react. And reaction is what markets feed on. This is how strong narratives are tested. Every major gold cycle in history has had moments like this: violent pullbacks, shaking volatility, conviction checks. Most participants don't fail because they're wrong. They fail because they're unprepared. Unprepared for volatility, unprepared for drawdowns, unprepared for how markets actually move. Gold doesn't trend smoothly. It surges, it stalls, it snaps back violently. That's the cost of being a monetary asset in a leveraged system. Here's the key point. If this were a real collapse, you would see more than price. You would see liquidity disappear. You would see buyers step away. You would see confidence break at the foundation. That's not what's happening. What's happening is stress being released, excess being removed, fragility being reduced, and that's uncomfortable to watch in real time because markets feel chaotic at turning points. Now let's look at what's happening away from the chart. Because while price has everyone's attention, behavior is telling a different story. Large buyers didn't vanish. They didn't panic. They didn't rush for the exits. They slowed down. And slowing down is not the same as selling. When markets get violent, smart money doesn't chase. It waits. Gold's pullback forced leveraged players out. But it didn't push long-term demand away. Central banks didn't dump gold. Sovereign buyers didn't reverse course. Long-term hedgers didn't abandon their positions. They watched volatility do its work. This is how accumulation phases are created. Not during euphoria, not during headlines, but during confusion. Here's something most people never notice. When gold sells off hard and physical demand remains steady, the market quietly tightens. Supply doesn't expand just because price falls. Mining doesn't respond overnight. Refining and delivery don't speed up. But paper selling happens instantly. It creates a gap between perception and reality. And that gap is where opportunity lives. Another thing they're missing: volatility itself is a tool. It discourages participation. It exhausts attention. It makes people doubt themselves. And once doubt replaces confidence, markets stop trending emotionally. That's when structure resets. Open interest drops. Leverage falls. Risk compresses. Those aren't bearish developments. They're stabilizing ones. The loudest selling already happened. The weakest holders already left. What remains is quieter, more patient, more intentional. And quiet markets don't collapse. They prepare. This is why timing after a crash is so difficult. Nothing looks obvious. Nothing feels urgent. And that's by design. Because the market doesn't want participation at this stage. It wants boredom. Boredom is the final filter. If you can sit through uncertainty without reacting, you pass the test. If you need constant confirmation, you get shaken out. Gold isn't breaking down. It's compressing. And compression is pressure stored. This is where most people mentally check out. They assume the move already happened, that the opportunity is gone, that gold already showed its hand. But markets don't resolve after chaos. They reset. And resets are subtle. After volatility like this, price stops being the signal. Behavior becomes the signal. You'll see days where nothing happens. Tight ranges, low volume. And people will call it dead money. That's the trap. Because markets don't bottom on excitement. They bottom on indifference, when no one cares, when no one's watching. When the narrative disappears, that's when positioning quietly shifts. Strong hands don't need confirmation. They need stability. They watch for selling to fail. They watch for bad news to stop pushing price lower. They watch for volatility to contract. Those are not emotional signals. They're structural ones. Another mistake people make is expecting clarity. Clarity comes after the move, never before it. By the time gold looks safe again, price will already be higher. That's how markets work. This phase is uncomfortable because it offers no reassurance, no fireworks, no headlines, no urgency, just waiting. And waiting is hard for anyone trained to react. Here's the bigger picture most people miss. Gold didn't crash because it's weak. It crashed because it was strong enough to attract leverage. Leverage always creates instability, and instability always ends the same way. with forced exits. Now that leverage is gone, the market is cleaner, more resilient, which means future moves don't need excess fuel. They need patience. If you understand that, you stop trying to predict the next candle, you stop reacting to noise, and you start watching the things that actually matter. Risk, positioning, behavior. Gold is not sending a fear signal right now, it's sending a disciplined signal. A signal that says this market rewards those who can sit through uncertainty without needing to be right every minute. Most people won't. They'll look away, they'll move on, they'll forget about it. And that's exactly how the next phase begins. Not with a headline, but with silence. And by the time gold reminds everyone why it matters, the opportunity will already belong to those who stayed when nothing was happening.